In 1989, Japan had more than 140 banks. By the end of the decade, only a handful survived. In 1998, Russia lost nearly every private bank in the country. 94% vanished in less than a year. 2008, America came within hours of the same fate. But that wasn't the end. And now, as the clock strikes January 2026, the data shows something chilling. The United States has quietly entered Stage 3 of the same five-stage collapse pattern that destroyed four nations before it. The pattern always begins the same way, with confidence. It ends with silence. Banks rise. Economies boom. Then one by one, they fall. Only this time, the cracks are deeper, and the countdown has already begun. Every system fails predictably, if you know where to look. For decades, financial historians have tracked the same five stages across collapsing banking systems: overconfidence and expansion, easy credit, rising assets, deregulation, liquidity compression, short-term debt surges while savings decline, institutional strain, mid-sized banks begin to fail, consolidation accelerates, panic and contagion, interbank trust collapses, credit freezes, reconstruction and regret. Governments nationalize, print, or restructure. In Japan, it took 12 years. In Iceland, only 10 months. In the U.S., the first two stages are already history. And Stage 3, the institutional strain, begins January 2026. If the pattern holds, by 2028, the U.S. could lose over 70% of its banks. The stakes are bigger than numbers. Because when banks die, so do dreams. Families, small towns, futures, and as you'll see, one small event in a Colorado suburb, a bank merger barely noticed by Wall Street, will ignite the spark that sets the next collapse in motion. In the summer of 2025, report began surfacing of temporary liquidity gaps across several regional banks. They called it routine. But deep inside the Federal Reserve's 11th district, an economist named Dr. Lauren Grant noticed something alarming. Her screen showed a pattern she'd only seen in old IMF case studies. A synchronized withdrawal compression curve. Customers weren't pulling money out all at once. They were stopping new deposits. A silent run. She flagged it in an internal memo. Pattern consistent with pre-collapse banking systems. Recommend review. No one replied. Meanwhile, David Moreno, a small business owner in Fort Collins, Colorado, noticed his loan renewal suddenly doubled in rate. His bank, Mountain Trust Financial, blamed new liquidity guidelines. By fall, Mountain Trust announced a merger with a larger bank from Chicago. A week later, branches began closing across rural Colorado. Local news covered it for a day. Wall Street didn't notice. But Dr. Grant did. And so did one other person, a journalist named Ethan Price, a former Wall Street analyst turned independent reporter. He'd seen this before. In 2007, behind closed doors in D.C., Treasury officials met with the Federal Reserve's crisis team. The issue wasn't insolvency, not yet. It was confidence. The FDIC was quietly modeling scenarios for 2026. What if 15 regional banks failed in a single quarter? What if deposit insurance costs doubled? Charts filled the room. The average age of U.S. regional banks was dropping, not because of new ones, but because old ones were disappearing. Since 2010, America had lost over 4,000 banks, largely through mergers. But by mid-2025, the rate of consolidation doubled again. One internal note, later leaked, summarized a fear in one sentence. We are entering a phase where deposit concentration may outpace regulatory coverage. Translation: too few banks holding too much money. And if one fails, the system follows. David's shop, a small construction supply business, had survived 2008. He'd learned how to tighten credit, save cash, and wait out the storm. But this time felt different. When his payroll system bounced a routine transfer, his manager called the bank. The line rang for 20 minutes. Then an automated voice said, "We are experiencing unusually high call volumes. Please try again later." 2 days later, the local branch was boarded up. Across town, his wife Emily scrolled through Facebook, post after post of friends saying their accounts were frozen due to migration. But migration to where? That night, David received an email titled, Your account will be automatically migrated to Horizon National Bank effective December 30th. He'd never heard of Horizon National, and in the months to come, that name would become infamous. By December 2025, headlines turned optimistic again. The Dow hit new highs. Inflation fell. The president announced the banking sector remains resilient. But inside the Federal Reserve, Dr. Grant's models painted a darker picture. Liquidity buffers were being rebuilt, but only at the top. The mega banks, JP Citigroup, Wells Fargo, were swallowing smaller institutions faster than ever. A single policy meeting in November 2025 revealed the truth. 50% of all U.S. deposits were now controlled by 4 banks. Historically, every nation that reached that threshold entered Stage 3 within months. Still, the public didn't know. The markets cheered. And Horizon National Bank, the one absorbing Mountain Trust accounts, ran glossy Super Bowl ads about building America's next financial era. Meanwhile, Ethan Price began connecting dots. He traced Horizon's capital injections to a Cayman subsidiary linked to a defunct 2008-era hedge fund, the same one that had shorted subprime mortgage securities. He published an article, The 5-Stage Pattern Returns, Is the U.S. Next? It went viral, then disappeared within 48 hours. The hosting site cited compliance review. By Christmas 2025, whispers spread through finance Twitter, #Stage 3. And on January 2nd, 2026, as markets reopened for the year, Horizon National's quarterly report hit the wires. It showed record deposits, soaring profits, and unprecedented exposure to short-term commercial paper. The same mix that doomed Lehman Brothers. Still, the stock market rose. The Fed remained silent, and Dr. Grant quietly submitted her resignation. In her final memo, she wrote, "History doesn't repeat itself. It compounds." On screen, a line graph flickers, the number of operating banks in the United States. It's dropping faster than at any time since 1933. A digital clock fades in. Stage 3, commencement, January 2026. 4 countries lost 90% of their banks before anyone believed it could happen. The United States is about to test a pattern once again. Washington, D.C. is calm on the surface, but inside the Treasury's Crisis Management Unit, the mood is shifting. The Federal Reserve's regional chairs meet in a closed session. On the agenda, liquidity concentration risk. The numbers are stunning. Horizon National, the bank that absorbed dozens of smaller lenders, now holds $1.2 trillion in insured deposits with unverified derivatives exposure more than twice that. Behind the scenes, a name surfaces again and again, Vanguard Delta, a private equity firm that financed Horizon's rapid expansion. On paper, Vanguard Delta looks legitimate, managing pension funds and infrastructure investments. But a leaked email chain obtained by journalist Ethan Price reveals something sinister. Phase consolidation achieved. Market share target met. Next, strategic stress event. Was it possible the consolidation wasn't an accident, but a strategy? Dr. Lauren Grant, now outside the Fed, meets Ethan in a quiet Georgetown cafe. She's visibly nervous. Grant, you're missing the pattern's 5th dimension. Ethan, 5th? Grant, it's not just banks collapsing. It's control transferring. Every collapse ends with fewer institutions, but also fewer decision-makers. She slides a flash drive across the table. Inside, projections showing 5 firms controlling 88% of U.S. banking liquidity by 2028. If true, it means the collapse isn't pure chaos. It's a managed implosion. Grant, they're engineering it. The pattern isn't repeating. It's being weaponized. Does Ethan publish the evidence and risk triggering a panic, or stay silent and watch the collapse unfold? A small community bank in Ohio, Midwest Liberty Trust, fails after mysterious withdrawal wave drained 60% of its reserves overnight. Officials call it a localized cyber incident. But the FDIC report, leaked weeks later, shows that all the withdrawn funds were automatically routed to Horizon National. When Ethan confronts his contacts at the SEC, one senior analyst mutters off record. Horizon's algorithmic sweep accounts pool deposits the moment a smaller bank's risk threshold changes. It's legal, but catastrophic. In other words, Horizon's AI-driven liquidity system is harvesting weaker banks in real time. Ethan publishes his expose, The Bank That Eats Other Banks. The story detonates. Cable news calls it conspiracy. Horizon CEO Richard Kellen goes on CNBC. We are strengthening the financial backbone of America. These so-called leaks are irresponsible fear-mongering. But then, something impossible happens. The stock market doesn't fall. It rises. Investors pour money into Horizon stock, betting on its dominance. The public cheers the idea of a stronger, unified banking future. Across small-town America, the real pain begins. In Fort Collins, David Moreno can't make payroll. Horizon National temporarily pauses his business line of credit, citing updated internal lending frameworks. In Iowa, farmers find their seasonal loans delayed. In Texas, energy contractors face sudden rate hikes. These aren't isolated incidents. They're symptoms of consolidation. When one bank controls everything, risk tolerance narrows to a single algorithm. David visits his new Horizon branch, a glass and steel office replacing his old Mountain Trust location. The teller smiled politely, but every answer is scripted. Our systems are recalibrating. Please check your online dashboard. Except the dashboard doesn't load. Weeks later, Horizon servers glitch. Account balances temporarily disappear from 2.4 million users. The company blames a software migration error. But insiders tell a different story. It's a liquidity freeze, quietly ordered after an overnight credit swap failed to clear. That same weekend, Dr. Grant calls Ethan in panic. They've triggered stage 4 early. Markets tremble. Treasury yields spike. 2 regional banks halt withdrawals. The media blames temporary liquidity events. But inside the Federal Reserve, chaos reigns. A confidential memo surfaces. Derivative exposure linkage identified. Horizon National to 4 major pension funds. In short, if Horizon collapses, pension fund for 23 million Americans will evaporate. The government can't let that happen. Behind closed doors, a new emergency measure is drafted. The Financial Stabilization Accord of 2026. It grants the Treasury power to nationalize any bank deemed systemically essential. But here's the twist. When the order is signed, it lists only one name, Horizon National Bank. The collapse was the plan all along. By absorbing its rivals, Horizon positioned itself as too big to fail, by design. The U.S. government doesn't rescue the system. It hands it over. Ethan and Dr. Grant realized too late. The villain wasn't a person or even a corporation. It was a philosophy, centralization disguised as stability. The collapse wasn't financial chaos. It was a final stage of financial capture. The United States banking sector has been successfully consolidated under new federal oversight. Horizon National's logo quietly changes to the United States Financial Authority, USFA, a quasi-governmental entity run by a blend of former Treasury officials and private executives. Dr. Lauren Grant testifies before Congress, warning that the 5-stage pattern has reached its irreversible phase. We did not prevent the collapse. We institutionalized it. Ethan Price releases his final documentary, Stage 5, Reconstruction and Regret. It's viewed 40 million times before being mysteriously taken down. In Fort Collins, David Moreno's shop stands empty. A for-lease sign fades in the sun. Across the country, people feel safer, their account insured, their banks backed by the government. But the system is no longer theirs. In history books, it will read as a rescue. But in truth, it was a transfer of power. Inside are internal memos from Vanguard Delta predicting a global rollout of the same consolidation model across Europe, Canada, and Southeast Asia. The collapse wasn't an end. It was a beginning. The question now isn't whether it can happen again, but whether it ever really stopped. 4 countries lost 90% of their banks before anyone noticed the pattern. Now, America stands at the same crossroads. Was it greed, negligence, or design? If you think the pattern stops here, look closer. The next stage always begins in silence. If you want to see how the 5-stage collapse pattern could reshape global finance, subscribe, stay alert, and never stop questioning the system.